Most investors look at the purchase price first. Serious investors look at the financing score first. Because in CMHC-eligible multifamily investing, the number that quietly changes the entire deal is not always the price. It is often the point structure behind the financing. In this video, I want to show you why CMHC MLI Select points matter more than most investors realize. Because affordability, energy efficiency, and accessibility are not just boxes to check for compliance. They can affect how strong the financing becomes, how flexible the debt structure can be, and how the investment performs over time. If you're new here, I'm Darren from DK Wealth and Growth. And if you've been following along, you know we focus on disciplined, CMHC-eligible multifamily investing, not generic real estate theory. Stay with me until the end because I'm going to show you why two buildings with similar prices can produce very different investor outcomes once the CMHC scoring is understood properly. Where most investors start wrong. Most investors are trained to start with the obvious numbers: purchase price, down payment, projected rent, cash flow. Those numbers matter, but they do not tell the full story. Because with a CMHC-eligible multifamily deal, the financing structure is not just something that gets added at the end. It is part of the economics of the deal from the beginning. And this is where investors can get misled. A building can look expensive on the surface, but become more efficient because the financing structure is stronger. Another building can look cheaper upfront, but struggle because it does not score well enough to unlock the same financing advantages. So the price is only one part of the decision. The financing score can change what that price actually means, what the CMHC points are really doing. The first area is affordability. Most people hear affordability and think it only matters from a housing policy standpoint. But from an investor's perspective, affordability can also influence how the project is viewed inside the CMHC MLI Select framework. If a project is structured to provide qualifying affordable rental housing, that can strengthen the financing profile. And when the financing profile improves, the deal can become easier to hold, easier to stabilize, and easier to evaluate with confidence. So affordability is not just a social benefit. In the right deal, it becomes a financing strategy. That is the part many investors miss. They look at the rent level in isolation, but they do not always ask what that rent level does to the financing structure behind the deal. The second area is energy efficiency. Again, this sounds like a construction detail. Better windows, better systems, lower energy usage. But inside the financing conversation, energy efficiency can matter because it may help the project score higher. And a stronger score can support better financing terms depending on the full structure of the application. That means the building is not just being evaluated for how it looks today, it is being evaluated for how it operates over time. That matters because investors do not just own the purchase price, they own the operating reality. If the building is more efficient, the cost profile can be more resilient. And if the CMHC scoring is stronger, the debt structure may become more attractive. That is where small technical details can turn into real investor outcomes. The third area is accessibility. This is another one investors often overlook. They may see accessibility as a design requirement or a construction cost. But under CMHC MLI Select, accessibility can also contribute to the scoring strategy. And when you combine accessibility with affordability and energy efficiency, the deal may become more competitive from a financing standpoint. This is why a serious review does not just ask, what is the cap rate? It asks, what is the financing path and how does the project qualify? Because the power is not always in one category. The power is in the stack. Affordability, energy efficiency, and accessibility can work together to improve the financing story. And when that happens, the deal is not just being purchased, it is being structured. Quick question for you. When you look at a multifamily opportunity, what do you usually check first? The purchase price, the down payment, the cash flow, or the financing structure? Drop it in the comments. I read through them and it helps shape what I break down in future videos. Why the score changes investor outcomes. Here's why this matters. CMHC MLI Select is not just about getting a loan. It is about creating a financing structure that can support the investment over time. The amortization, the leverage, the insurance incentives, the debt service pressure, and the long-term hold strategy can all be affected by how the deal is structured. So when a project scores well, that can change the conversation. Not because the risk disappears, but because the financing may become more aligned with the way the asset is supposed to perform. So the takeaway is this: most investors compare deals by looking at price, but serious investors compare deals by looking at structure. And in CMHC-eligible multifamily, the point system can quietly change the entire structure. That is why the best question is not just how much does it cost. The better question is, how does this deal score, and what does that do to the financing? If this kind of disciplined approach to multifamily investing resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate CMHC-eligible opportunities, financing structures, and the risks that are not always obvious in the first set of numbers. And if there's a topic you want me to cover next, drop it in the comments. I read through them, and it helps shape future videos. If you want to explore opportunities that have already been filtered through this kind of process, you'll find links below where you can join the investor list or learn more. And in the next video, we're going to talk about something that surprises a lot of investors: why the down payment is not always the real bottleneck anymore. Thanks for watching, and I'll see you in the next video.